Becoming a foreign exchange trader takes plenty of knowledge and skill. You need to learn the signals that indicate market trends, understand the strategies you can use based on the market activity, and know when to implement those strategies. But to become a successful foreign exchange trader, you'll need more than just skill. When you trade, your success or failure depends on what happens in your mind. You need to be disciplined and stay away from impulsive tendencies and rash decisions. You need to internalize these mindsets that will guide you towards profit. Don't lose. Don't hold. Don't risk. The trend is your friend. Manage your ego and live to fight another day. So what do these mindsets mean to you? Don't lose means be realistic and remember that any profit is good. Take any chance you see to profit because you never know when the next opportunity will come. If you don't want to lose, then don't hold onto a position. An investor buys and holds to maximize profit, but as a trader, your mindset is to buy and sell quickly. Don't risk is a reminder that you can minimize your risks. Think about it this way. When you take a position, there is risk involved. But if you don't have a position, you're not risking anything. If you don't hold positions for long, you'll minimize your exposure time and you will lower your risk. The trend is your friend is your guide to buying and selling. It's easy to remember. Buy when the market is buying and sell when the market is selling. The last two mindsets are what keep you going for the long run. You must manage your ego to live to fight another day. Always remember that you don't have to be right, you just have to be profitable. When things aren't going your way, scale back and be prepared to get back to it tomorrow. It's okay to lose your shirt, but you don't want to lose your pants too. In this video series, you'll learn many of the basic skills necessary to trade on the foreign exchange market. But it's only when you pair those skills with these mindsets that you'll learn to become a true foreign exchange trader.
The foreign exchange market is a global market for trading currencies. It was once the arena of a select few, accessible only to the world's most sophisticated hedge funds, the largest investment banks, and the biggest corporations. But not anymore. The foreign exchange market, also called Forex, or FX for short, is now within your reach, and a basic understanding of it can help you start trading in the largest financial market in the world. Forex involves the exchange of currencies. Every transaction involves two currencies. One currency is bought while another is sold. For example, a euro-dollar buy trade would mean you are buying euros, and the price of those euros would be quoted in US dollars. This is often called an exchange rate. How much of one currency you'll need to buy a certain amount of another currency. And exchange rates are based on the supply and demand of the currencies on the market. The market itself is an electronic network of international buyers and sellers, with an estimated daily trading volume of 5.4 trillion US dollars. For comparison, that's a trade volume about 200 times greater than the New York Stock Exchange. 2/3 of that volume is traded by the top 3 financial centers in the world: London, Singapore, and New York. While other big players in the market include Tokyo, Hong Kong, Switzerland, France, and Australia. But you don't need to be in those financial centers to access the market. Because it's fully electronic, Forex is increasingly accessible around the world. That means with the right tools and training, you can learn the skills necessary to become a Forex trader.
There are several reasons why it's becoming increasingly popular to trade currencies worldwide in the FX market. First, currencies are fungible. A fungible asset is one that is interchangeable with other units of that asset. If you buy a US dollar, its value will be the same as any other US dollar. The foreign exchange is the only 24-hour financial market that is both fungible and tradable. And since it opens the week in Australia and closes it in New York City, currencies are effectively traded for 5.5 days straight. More time equals more opportunity to trade. Forex also benefits from being a relatively liquid market. Liquidity refers to how easy it is for a particular currency pair to be bought or sold. Some pairs are easier to trade, are more liquid than others. In general, currencies can be bought and sold without restriction, frequently at large volumes. Another advantage of Forex is that it allows for non-directional bias trading. It doesn't matter which way the market moves, it just matters that you have a plan to enter a trade when it does move. If you have a trading plan in place for both possible outcomes, you can make a profit. In Forex, you can also use leverage, using a little bit of money to trade larger amounts. Say you have 1,000 US dollars. In Forex, you can sometimes get leverage of up to 100 times your initial capital, meaning you can trade at a position of $100,000 instead of just 1,000. Both your gains and losses will be multiplied by 100. If a trade at $1,000 would have profited you $1, with leverage it would profit $100. If it would have lost $1, with leverage it would lose $100. The high risks and rewards means that only experienced traders should use leverage. However, for those who have mastered the skills, leverage makes FX trading more about your decisions than how much money you have to start. In order to take full advantage of Forex's unique characteristics, successful traders take time zones into consideration when planning their trades. Currency pairs are most liquid and volatile when both countries' markets are open. This is when trading is at its highest volume and the biggest ticket transactions usually take place. For the euro-dollar currency pair, that occurs during the London-New York overlap, the period between 1 p.m. and 5 p.m. London time when both markets are open. The unique characteristics of Forex provide many opportunities for strategic trading and, of course, for profit.
To calculate the actual monetary value of gains and losses, FX traders use a standard unit of measurement known as a pip. PIP stands for percentage in point, and it measures tiny units of change within a currency pair. How tiny? In FX, most currency pairs report prices to 4 decimal places, so they look something like 138.10. For the euro dollar, a pip is the 4th value after the decimal point. 1 pip would be 0.0001, 2 pips would be 0.0002, and so on. If you enter a trade for euro dollar at a rate of 138.10 and it moves to 138.11, that 0.0001 change means that you gained 1 pip. Note that for other currency pairs, like the ones involving the Japanese yen, 1 pip would equal 0.01. For example, in pound yen, a move from 113.12 to 113.13 is a 1 pip move. Pips are a standard unit used no matter which currency pairs you're trading, but the monetary value of a 1 pip movement does vary. You'll need to find the value of 1 pip in your trade in order to calculate your profit or loss. To find the value of 1 pip, consider an example. Say you exchange 100,000 euros for dollars at a 138.10 exchange rate. That would get you $138,100. If that rate goes up 1 pip to 138.11, then exchanging 100,000 euros would be worth $138,110. The difference, $10, is the value of a 1 pip move here. Pips are small, but they add up, and an understanding of pip value illustrates how even aiming to gain just 1 to 3 pips can still mean trading success. Simply put, we have to think small to win big.
A candlestick chart is a price action chart that you must be able to read to execute the price action trading methodology. Candlestick charts show the price movements of a currency pair by marking the pair's opening price, closing price, and highest and lowest prices for a given time period. Each set of these price movements on a candlestick chart forms a candle. When we refer to charts by a time frame, we are referencing how much time each candle represents. For example, on a 10-minute chart, each candle represents price movement over 10 minutes. While on a 1-minute chart, each candle shows 1 minute of movement. That means 10 candles on a 1-minute chart would form in the time that one candle forms on a 10-minute chart. The two wicks of the candle indicate the highest and lowest trading prices for that period. The body of the candle tells us the range between the opening and closing prices. A black or red body means that the price closed lower than it opened. In that case, the top of the body represents the opening price, and the bottom represents the closing price. A white or green body means the price closed higher than it opened. The bottom of the body represents the opening price, and the top represents the closing. When the opening and closing prices are very close, the candle's body is very short. When the opening and closing prices are the same, the candle is called a doji. Candlestick charts help you tell how the markets feel about a currency pair. Candles with wicks indicate market uncertainty, while candles without wicks show clear market direction.
There are many complex charting tools that predict Forex movement, but these indicators often lag behind the market and can obscure more than they reveal. The simplest way to analyze the market is with a stripped-down approach called price action trading, or PAT. Price action trading is like reading the pulse of the market. It relies solely on actual recent price movements, or price action, to analyze the market. You don't need to try to predict the way the market will be affected by factors like recent news or events. You can look at a price action chart and see how it's being affected. The way to look at price action charts is the price action trading methodology, which involves looking at 3 price action charts covering 3 different time frames: a 10-minute chart, a 1-minute chart, and a 10-second chart. Each of these charts is made of data points that show price movement over those periods of time. Looking at each time frame reveals something different about the market's price activity, allowing you to see a price in 3 dimensions at the same time. First, there's the 10-minute chart, which shows you the general direction in which the market is trending. Then there's the 1-minute chart, where you can choose a level of entry, the price at which you want to enter a trade. Finally, you can use the 10-second chart for timing to decide exactly when to execute your trade. The success of your trade will largely be determined by your interpretation of the 10-second chart, but it is still crucial to review the other 2 time frames. With the 10-minute and 1-minute charts, you'll be able to see historical data that help ensure you make a precise, successful trade.
Let's use a simulated trade to see price action trading in motion. First, we'll review the 10-minute chart to determine the basic trend of the market. This market is bearish and generally on the decline. Next, we examine the 1-minute chart for a more in-depth view of the price movement and how that trend is holding. Here we can see the market testing price levels. This plateau is a resistance level. The market faced selling interest at higher prices, and prices fell from here. The price retraced back to this level to test this resistance. Because the prices are not exceeding that level, selling interest continues. This trend confirms that this is where we have the best opportunity to sell. But to find the exact entry point and confirm that this is the place to sell, we must look at the 10-second chart. Here, we see the selling trend through a series of lower highs and lower lows. Between each of these lower highs, you have the opportunity to sell and buy back. You would have made 3 pips, 3 pips, and 8 pips.
You'll need to be able to identify the market trends to apply the price action trading methodology effectively. A trend is the general direction of the market's price, which can usually be described in one of 3 ways: as an uptrend, a downtrend, or a range. A market on an uptrend, often called a bullish trend, is characterized by a series of increasingly higher highs and higher lows. Prices are rising. A downtrend or bearish trend is the opposite. Prices are falling, and you'll see a series of lower highs and lower lows. Sometimes, prices will fluctuate between a specific high or resistance level and a specific low or support level. This is known as a ranging market. On this sample 1-minute chart, you can see all 3 trends occurring. First, highs and lows are increasing. The trend is bullish. Once the market starts moving sideways without significant highs or lows, we're observing a range-bound market. Finally, a support level is broken. Lower highs and lower lows occur, signaling a bearish trend. In price action trading methodology, the trend is your friend. You don't know where highs and lows will form until they've already happened, so the safest way to trade is with the current trend. You'll have to keep your ego in check. Don't try to score big and predict the top or bottom of the market. Instead, trade with the trend. Buy on the way up and sell on the way down, making multiple trades for small, consistent profits. Trendlines are a tool used to establish, analyze, and confirm a market trend. They're a visual representation of the direction of a price created by connecting a series of highs or lows. In the price action trading methodology, you'll use a 3-point trend line to confirm trends on the 10-minute chart. For this type of trend line, the first 2 points form a potential trend, and the third one confirms it. The first point is known as the incident. It marks the price level at which a new trend begins to form. The second point is the coincident. In an uptrend, it's the first higher low above the low of the incident, and these 2 points will be connected with a dotted blue line. In a downtrend, it's the first lower high below the high of the incident, and you'll use a dotted red line. Your confirmation point will be either another higher low for an uptrend or another lower high for a downtrend. When you've marked this third point, change your line from dotted to solid. The trend line is confirmed when the price breaks the previous high of an upward trend or the previous low of a downward trend. Note the trend lines are more like zones. The price will not always hit the trend line exactly. Trends on the 10-minute chart are more significant and hold for longer time periods than trends on charts of lower time frames. Smaller periods of time have more volatility and may even have trends that differ from the standing overall trend line on the 10-minute chart. Once you can identify trends on a 10-minute chart, you'll be better informed when reading the 1-minute and 10-second charts, and not be misdirected by the volatility often seen in those smaller time frames.
A channel is another market analysis tool. It's a set of 2 parallel lines that contain the price action of the market. To create a channel, start by making a trend line on your 10-minute chart. Then duplicate that trend line and slide it over to bound the other side of your channel. When the market is trending upward, this is called an up channel. For a downtrend, move the new line to the parallel set of lower lows. This is called a down channel. Just like a trend line, a channel is tested as new highs and lows form. And the price moves above or below your channel lines. You can adjust them to accommodate the new high or low. First, redraw your trend line, then use it as a basis for the new channel. Here, the new channel is steeper than the previous one. Your new channel lines are tested and confirmed if they are not broken by the next high or low. Channels are useful because they help traders manage their profit expectations and select better entries after pullbacks. They help us see where prices can reasonably be expected to move, allowing us to identify the best places to enter a trade and the best prices for taking profit.
Price action charts are windows through which we can see how Forex traders feel about the market at a given moment in time. Market trends form according to an underlying psychology, and understanding that can help you better understand the movement of prices. Take, for example, a market with a bullish sentiment. Which means an uptrending market where a series of higher highs and higher lows is forming. In a bullish trend, the buyers, also called the bulls, are in control of the market. Bulls profit in up moves and sell at the highest point possible. They keep buying, which increases demand and drives prices up, until they think the market won't tolerate any further price increase. At this point, the bulls will take profit by selling, and the increased supply on the market will drive prices back down. Prices will continue falling until the bulls decide to buy again at the new, lower price. This once again increases demand and causes prices to rise, leaving behind a new low, which will usually be higher than the previous low. If this new increase in demand leads to a new higher high, you'll have your coincident point and the basis for a trendline analysis. Note that this second higher high is a result of crowd behavior. Seeing an uptrend forming, additional buyers entered the market, further increasing demand and enabling prices to rise past their previous high. A bearish trend is the opposite of a bullish trend. In a bearish trend, the market is controlled by the sellers, also known as the bears. The bears' strategy is to sell in order to increase supply and drive the price of a currency down. When they think the price is at its lowest, they begin buying, which increases demand and drives the price up, creating a new lower low. Bears see the rise in price as an opportunity to make a profit, so they start selling again, decreasing demand and driving the price down before it rises above the previous high.
Just like with bullish trends and bearish trends, there is an underlying psychology to ranges that can help you understand the reasoning behind price movements. In a range, there's no clear direction of price movement, and we can tell that there is uncertainty in the market. Ranges show a battle between the bulls and the bears, with each trying to determine the next market direction. At lows, the bulls will buy, thinking that the price will not decrease anymore. This causes an increase in demand and causes prices to rise. At highs, the bears sell because they think the price will not rise any further, causing an increase in supply and moving the price down. This back and forth creates a lack of significant highs or lows, resulting in a range. By understanding traders' motives and how that affects price movement, you'll gain a better understanding of the way the market moves, and you'll learn to maximize your profits using the price action trading methodology.
We know that trends are your friend, but the truth is that eventually, all trends must end. And there is no guaranteed way to know exactly when a trend will reverse. However, we can use Fibonacci retracements on 10-minute and 1-minute charts as a guide to help us predict when the market will shift direction. At the simplest level, Fibonacci retracements are lines that we can superimpose over a price action chart. They help us understand when price movements are just retracements, short-term changes within a longer-term trend, or if a movement is a signal of a trend reversal. To find the Fibonacci retracements for a given price action chart, we first identify the lowest and highest points in an upward trend and form lines at those levels. Then, we can use a Fibonacci tool to superimpose lines at the key Fibonacci levels, which are 23.6%, 38.2%, 50%, and 61.8%. These lines indicate levels at which support and resistance levels often form. The 50% and 61.8% lines are key levels to watch because they are the last levels of defense to maintain a trend. Pullbacks from a trend often hit those lines before continuing in the direction of the trend. However, if a pullback definitively crosses the 61.8% line, then it is highly likely the trend has ended. Fibonacci retracements alone don't signal a definite trend reversal, but they do provide more information to help you make educated trading decisions. By combining this skill and others with price action trading, you can learn to confirm trend reversals and maximize your trading profits.
Sometimes, even when the market is holding to a reliable trend, you might observe a brief deviation. This temporary detour is called a continuation pattern. It's a recognizable pattern that occurs in the middle of a broader trend, but after which the trend will likely resume. Continuation patterns occur on all time frames, and there are many kinds, each with their own specific shapes. But in the price action trading methodology, you'll focus on two types in particular: triangles and flags. Both are easily identified on and usually occur after a sharp rally or sharp drop in price. A triangle continuation pattern is created when a price range converges after a sharp price movement. There will be a series of higher lows and lower highs, which creates the appearance of a triangle. Flags are more of a pause in a trend, a pattern in which price action becomes confined to a small range within a channel. A preceding sharp rally or drop forms the flagpole in this pattern and gives it its characteristic flag shape. During a continuation pattern, traders are often pausing their previous behavior. Some may be busy selling and taking profit, while others are sitting on the sidelines and observing. Once the continuation pattern breaks, the prevailing trend usually continues, which is why these patterns are often thought of as a pause in a trend. Even in a continuation pattern, the trend is our friend. Knowing these patterns will help you identify opportunities to enter trades. A triangle continuation pattern is a short-term pattern often found on 1 and 10-minute charts. These patterns form when price consolidates after a sharp rally or drop. You can see the triangle shape made of highs and lows that form smaller ranges as price moves. You can see the triangle clearly by drawing two trend lines. The bottom one, connecting the lows, indicates demand, and the top one, connecting the highs, indicates supply. When the price breaks out of triangle continuation patterns, it will continue with a sharp movement in the direction of the preceding trend. As you will learn with triangle consolidation patterns, there are multiple kinds of triangle patterns: symmetrical, non-symmetrical, ascending, and descending. Each type of triangle continuation pattern looks a little different, but to find the measuring objective in any triangle pattern, you can calculate the distance from the first point in the trend to the extended trend line on the opposite side. Then, project this distance in the direction of the breakout to estimate how far the trend will continue. Understanding the way the market behaves during and after a triangle continuation pattern will help you predict price action and be better prepared to make smart trades.
Flag continuation patterns occur mid-trend, after a sharp rally or drop in price. You can expect the previous market trend to continue once the flag pattern breaks. The sharp rally or decline that precedes the price consolidation forms the flagpole of this pattern. The flag itself is formed by two parallel trend lines that connect a series of highs and lows. A bullish flag occurs in a bullish market trend, when the flag lines are connecting lower highs and lower lows. When the market breaks the pattern, it will resume trending upward. A bearish flag is the opposite, and flag lines will connect higher highs and higher lows before the market resumes its downward trend. In this example, the market is bearish and the price is dropping sharply. This is the flagpole. You can see that as a retracement pattern begins, the flag pattern forms, continuing until price breaks out of the consolidation period, and the trend continues downward. To find the measuring objective of a flag pattern, measure from the point where the price rises or drops sharply to the first point in the pattern. Then project that distance from the point where the pattern is broken. That will give you an estimate of how far you can expect the trend to continue.
To determine when a trend has ended, look on the 1 and 10-minute timeframes for a key reversal pattern, a particular kind of pattern that only forms at the end of a trend, after an extended rally or decline. These patterns develop when market sentiment changes and are the result of a struggle between bulls and bears. If the traders who own the current trend win the struggle, a continuation pattern will form. But if the trend owners do not win, the trend will reverse, and you'll see a key reversal pattern. Price action trading methodology looks at two sets of key reversal patterns, the double top and its opposite, the double bottom, as well as the head and shoulders and the inverted head and shoulders. When applying price action methodology, you'll need to be careful not to mistake key reversal patterns for retracements. Retracements are temporary, and while they may look like a key reversal on the 10-second chart, they generally won't show reversal patterns at the 1 and 10-minute levels. Instead, the overall market trend line will still likely hold. If you see a key reversal pattern in the 1 and 10-minute charts, you're likely seeing a longer-term shift in market direction. If you can identify key reversal patterns, you'll be able to see when a change in the market trend is about to occur, and this will help you assess the potential risks and rewards of a trade.